You know that feeling, right? You open your crypto app and it's just this wall of numbers, red, green.
Oh, yeah. Total information overload sometimes.
Exactly. And you hear terms like DeFi, yield farming.
Yeah.
It's kind of hard to figure out what's really making the market tick. So today, we want to cut through some of that noise. We're diving deep into something really fundamental, liquidity provision.
Absolutely key. You can think of it as the grease and the gears of the crypto market.
Yeah, the oil keeps the engine running smoothly. Without it, trading gets clunky, prices get jumpy.
Right. Liquidity just means there are enough buyers and sellers around so you can trade easily without causing huge price swings yourself. It's vital, especially in crypto.
And that's what brings us to our deep dive for you today. We're looking at this really interesting academic paper. It's called Returns from Liquidity Provision in Cryptocurrency Markets.
Yeah, it's a solid piece of research, not just hype. It digs into the data to see what actually drives the returns for the folks providing this liquidity.
So they're looking at who's getting compensated for making trading possible, basically.
Exactly. And why? The paper uses a ton of data, lots of cryptos, over several years. It's trying to pinpoint the real factors.
Okay, so our mission here is to kind of unpack that for you. Pull out the key stuff, make it make sense, maybe even find some surprising connections.
Yeah, give you that aha moment without drowning you in academic speak.
We're pulling together insights you might find scattered across, articles, research, maybe your own notes, and putting it into one place for you.
Sounds good. So where should we start? Maybe just nail down what liquidity provision is in crypto, or how does it actually work on the ground?
Good idea. So you've got your big centralized exchanges, right? Your Coinbases, your Binances.
CEXs.
Right. On those, you have these players called market makers, often big firms. They're constantly putting in buy and sell orders.
Creating that two-sided market you need.
Exactly. And they make money on the spread, that tiny difference between the buy price and the sell price.
Standard stuff for traditional markets, too. But then you have the crypto twist.
Which is the decentralized exchanges, the DEXs. Like Uniswap is the big one people know.
Right. And here, it's different because of the blockchain tech underneath.
So instead of market maker firms, you get AMMs, automated market makers.
And that means regular users, maybe even you, can provide the liquidity. You deposit pairs of tokens into these pools.
Liquidity pools, yeah.
And smart contracts handle the pricing and trading automatically, based on the ratio of tokens in the pool.
So the blockchain lets anyone participate, potentially. And the paper mentions this could lead to, well, good things like lower trading costs, more transparency, maybe faster trades.
That's a potential, definitely. More open, maybe cheaper. But it brings us to a really key idea in the paper, the liquidity provision premium.
Okay, the premium, what is that exactly? Like a bonus?
Sort of, yeah. Think of it as the extra return you might get for putting your capital out there, for providing that liquidity service. Especially, the paper finds, when the market's feeling uncertain.
Ah, so it's like hazard pay for providing stability when things are shaky.
That's a great way to put it. And they measure this premium in a pretty smart way. They use something called a short reversal strategy.
Short reversal.
Yeah.
Okay, break that down.
So imagine you systematically buy the cryptos that did poorly recently, say, over the last day or week.
The losers.
Right. And at the same time, you short sell the ones that did really well, the recent winners.
Okay. Buy the losers, short the winners. Why does that measure the liquidity provider's return?
Because liquidity providers are often the ones taking the other side of those short-term moves. When everyone's panic selling, they might be buying. When everyone's piling in, they might be selling. They smooth things out.
Okay. So the profit from that reversal strategy is kind of a proxy for how much those liquidity providers are getting paid for stepping in during those temporary imbalances.
Exactly. It captures that compensation for absorbing short-term fluctuations.
Got it. So they measure this premium, and then the really interesting part, they try to figure out what predicts it. What makes this premium go up or down?
Right. And this is where uncertainty comes in big time. They looked at a bunch of different ways to measure market uncertainty.
Like volatility, price swings?
Yep. They looked at SPOTVL, that's spot volatility, kind of the immediate price choppiness.
Okay.
And also LTV, left tail volatility. That one's more focused on the risk of big, sudden drops, like flash crashes.
The nasty downside risk.
Exactly. And they also used RV, realized variance, which is basically looking at how much prices actually move day to day across the crypto market.
Okay, so 3 different angles on volatility. What did they find? Did more volatility always mean a bigger premium?
Well, this is where it gets nuanced. So they found that higher SPOTVL, that sort of day-to-day chop,
Yeah.
actually tended to lower the premium.
Lower it. Really,
Yeah.
I would have thought more swings, more chances for market makers.
It seems odd at first, yeah. But one theory is that when prices are just bouncing around like crazy short term, market makers might protect themselves by widening their spreads, the gap between buy and sell prices.
Ah, so they make it more expensive to trade.
Right. And that wider spread might actually eat into the profits of that specific short reversal strategy they use to measure the premium. It makes those quick flips less profitable.
Okay, that makes a bit more sense. But what about the other volatility measures, the scary ones?
Right. LTV, the left tail risk, the chance of a big drop, that positively predicted the premium.
Okay, that fits the hazard pay idea. If there's a bigger perceived risk of things tanking, liquidity providers want more compensation for being there.
Exactly. It's like, okay, I'll stand here and provide bids, but you got to pay me more if the floor might drop out.
Makes perfect sense. And the RV, the realized variance.
That also positively predicted the premium. So higher actual market turbulence generally meant higher compensation. It reinforces that uncertainty link.
So volatility matters, but the kind of volatility matters. Sharp drops are different from just general noise.
Precisely. And they didn't stop at volatility. They also looked at RA investor risk aversion.
So how nervous investors are feeling overall.
Yeah. And higher risk aversion also predicted a higher premium. When people are generally scared, providing liquidity feels riskier, so providers demand more reward.
Okay, consistent theme. What else?
They also looked specifically at crash risk using a measure called NCSQW and general tail risk, just called tail.
More measures of potential bad stuff happening.
You got it. And both of those also positively predicted the premium. The higher the market thinks the chance of a nasty drop is, the more liquidity providers get compensated.
Wow. Okay, so it really hammers home that point. Uncertainty in almost any flavor you measure it seems to drive higher returns for liquidity providers. The market pays for stability.
That's a great summary of it. And there was one more kind of specific uncertain factor they looked at. Tether liquidity. Divin of Tether, they called it.
Ah, Tether, the big stable coin. How does its liquidity affect the premium for other cryptos?
Well, they found that changes in how easily Tether itself could be traded also impacted the premium on other coins.
Huh. So if Tether gets harder to trade, it makes providing liquidity elsewhere more valuable.
It seems so. It just shows how interconnected everything is. The plumbing of the main stablecoin affects the whole system.
And it really does. And it's fascinating that they mentioned this mirrors stuff seen in traditional stock markets, right? Like the U.S. equity market.
Yeah, that's a key point. This idea that market makers get paid more during turmoil isn't unique to crypto. It seems to be a more general market principle. Providing liquidity in uncertain times is risky, and markets tend to compensate for that risk.
Okay, cool. So let's shift gears a bit. The paper also dug into the CEX versus DX thing, right? Centralized versus decentralized exchanges.
It did, yeah. Specifically looking at Uniswap as the big DX example.
And how does liquidity provision play into that competition?
Well, they found something really interesting. When things on Uniswap got better, like more liquidity available there, higher trading volume, more transactions happening.
So when Uniswap becomes more efficient.
Exactly. When that happened, the liquidity provision premium on the centralized exchanges actually went down.
Oh. So if it gets easier or cheaper to trade on a DX like Uniswap, the CEXs don't need to pay their liquidity providers as much.
That's what the data suggests. It's like they're competing for the same liquidity. If the DXs becomes a more attractive place to trade or provide liquidity, it eases the pressure on the CEXs.
Fascinating. Like water finding its level, kinda?
Yeah.
What about the other way around? What if things get rough on Uniswap?
Then they saw the opposite effect when there were more withdrawals from Uniswap pool.
People pulling their money out.
Yeah. Or when Ethereum gas fees got really high, making Uniswap expensive to use.
Which happens.
Right? Or when impermanent loss was higher.
Quick reminder on impermanent loss. That's the risk you take in AMMs, where the value of your deposited tokens might end up lower than if you just held them separately.
Exactly. So when those negative factors on Uniswap were higher, the liquidity provision premium on the centralized exchanges went up.
Okay, so if providing liquidity on the DX becomes less appealing or more costly, the CEXs have to sweeten the deal to keep liquidity flowing on their platforms.
That's the implication. It really points to this dynamic competition between the two models. What happens on one side affects the other.
It's not two separate worlds. They're clearly influencing each other. Okay, now, this next bit really surprised me, the connection to global stock markets.
Yeah, this was one of the standout findings, I think. They didn't just look within crypto. They compared the crypto liquidity premium to the premiums in the stock markets of the US, Canada, China, and Japan.
And what did they find? Was it all linked?
They found two different patterns. For China and Japan, they saw what they called a common shock effect.
Common shock. Meaning?
Meaning, when the liquidity provision premium went up in the Chinese or Japanese stock markets, it also tended to go up in the crypto markets.
Huh. So maybe similar factors like regional economic news or regulations were affecting liquidity providers in both asset classes in those areas.
That's the likely interpretation. Some shared underlying driver affecting willingness to provide liquidity across both traditional stocks and crypto in those specific regions.
Interesting. But it was different for the U.S. and Canada.
Totally different. For the US and Canada, they found a substitution effect.
Substitution. Like one replaces the other?
Kind of. In this case, when the liquidity premium went up in US or Canadian stock markets, the premium in crypto tended to go down.
Whoa, wait. So if it becomes more profitable to provide liquidity in U.S. stocks, providers maybe pull back from crypto, making the crypto premium fall. Or, hang on, let me think that through.
It's the other way around with the premium measure. Think of it like this. If US Canadian stocks are offering really good returns for providing liquidity, maybe the capital dedicated to market-making flows there instead of crypto.
Ah, okay. So the opportunity in stocks draws capital away, potentially reducing the available liquidity provision effort in crypto, but maybe the measured premium based on that reversal strategy reacts differently. Or maybe it means providers see them as alternative arenas.
The paper suggests they might view them as alternative arenas, yeah. If providing liquidity in U.S. stocks is highly rewarded, perhaps the capital allocated to doing the same in crypto decreases, or the dynamics shift. Conversely, if stock liquidity premiums are low, maybe crypto looks more attractive for that activity.
So providers might be choosing, okay, do I deploy my liquidity providing capital in NASDAQ today or in Bitcoin?
That's the idea behind the substitution effect. It highlights that the capital providing this crucial function is potentially quite mobile and discerning, looking for the best risk-adjusted returns, even across very different markets and geographies.
That really connects crypto to the wider financial world in a way I hadn't fully appreciated. These aren't just separate sandboxes.
Not at all. It's becoming increasingly interwoven.
Okay, so big findings. But you always got to ask with academic stuff, how sure are they? Did they kick the tires on this? Run robustness checks.
Oh, yeah, absolutely. Good research practice. The paper mentions a whole battery of tests they ran.
Like what?
Well, they checked if the results held up when they accounted for market risk changing over time or controlled for the total supply of liquidity out there. They even looked at network effects. Metcalfe's law stuff in crypto.
And the main results about uncertainty driving the premium held up.
They did. The core findings remained pretty consistent. They also controlled for crypto-specific factors like size, momentum, even the impact of Bitcoin futures trading. They even used some high-frequency data.
So it seems pretty solid, not just a statistical fluke.
The consistency across different tests definitely adds confidence, yeah.
Okay. And one last detail they looked at was market cap, right? Did these factors affect big coins like Bitcoin differently than smaller altcoins?
Yes, that was another important nuance. They split their crypto sample into small cap and large cap groups.
Was there a difference?
There was. They found that all those uncertainty factors we talked about, the volatility, risk aversion, tail risk, they had a stronger impact on the liquidity provision premium for the smaller cryptocurrencies.
That makes intuitive sense, doesn't it? Smaller coins are often seen as riskier, maybe less liquid to begin with.
Exactly.
So during uncertain times, liquidity providers would probably demand an even bigger premium to step into those relatively thinner markets compared to, say, Bitcoin or Ether.
Precisely. It underscores that while the general principles apply, the magnitude of the effects can differ depending on the specific characteristics of the crypto asset. Size matters here.
Okay, wow. We've covered a lot of ground, from CEXs versus DXs to global stock markets. Let's try and wrap this up. What are the main things you, listening, should take away from this deep dive?
I think the absolute #1 takeaway is how much uncertainty dictates the returns for crypto liquidity providers. All those different measures, volatility, risk aversion, crash risk, they consistently point to higher compensation when the market feels risky.
Right. Providing stability isn't free. Market pays for it, especially when stability is scarce.
Exactly. Second big takeaway is the interplay between centralized and decentralized exchanges. They're not isolated. Improvements or problems on one side, like with Uniswap, directly impact the incentives on the other. It's a competitive dynamic.
Yeah, that was really eye-opening. And third,
The surprising connection to global stock markets, that common shock effect with China-Japan and the substitution effect with the US-Canada, it just shows crypto isn't operating in a vacuum. Global capital flows and risk perceptions link everything together.
So the big aha, for me, really, is seeing that interconnectedness. How things like stock market liquidity in Japan or Uniswap transaction fees or investor fear about crashes, they all weave together to affect this fundamental crypto market function.
And understanding these connections is valuable, not just if you are a liquidity provider like a big firm, but also for anyone trying to understand the market or even for policymakers.
Oh, so for policymakers.
Well, knowing what drives liquidity could help them think about financial stability. How do you ensure there's enough liquidity during a market panic? Understanding these premium drivers might offer clues.
Right. Managing those liquidity crunches. Okay. Makes sense. So, time for that final provocative thought for you to chew on.
Okay, let's hear it.
All right. So, we've seen how interconnected things are. CXs, DXs, global markets, regulations bubbling up. So, consider this. If a major country or region imposes significant new regulations, maybe targeting DXs specifically, or perhaps stablecoins, how might that ripple effect play out?
Ooh, good question.
Could it, say, amplify that substitution effect we saw with the US and Canada, pushing liquidity provision activity even more strongly between traditional finance and crypto, depending on the rules? Or maybe it creates new common shop links if multiple regions adopt similar rules.
How would regulatory changes in one place reshape those global flows of liquidity and the premiums providers expect everywhere else?
Yes, exactly. How does that regulatory chess game potentially change the entire landscape of crypto liquidity based on what we've learned today? Something for you to mull over, maybe look at market events through that lens.
That's a heavy one to ponder. Definitely food for thought as the space keeps evolving.
Well, that wraps up our deep dive for today. Hope you found this look into liquidity provision useful.
Yeah, fascinating stuff.
Until next time, keep digging deeper.